if you're not taking advantage of the legal ways to reduce your tax bill and claiming every possible deduction, then the chances are you're simply just overpaying taxes. Leverage often missed tax deductions to reduce your tax liabilities and increase your rental property profits ultimately. So let's jump into it. The first one is depreciation. We talk a lot about depreciation and its role in real estate investing, and that's because we can't overstress how powerful it is for real estate investors. Depreciation is often considered, one of the eighth wonders of the world. Depreciation allows you to deduct the value of the property, excluding the value of the land, against your rental income over what the IRS deems its useful life. For residential rental properties, this is 27.5 years, and for commercial properties, this is 39 years. So let's take a look at a simplified example. You purchase a property for $325,000 with a land value of $50,000. That's $375,000. It's a long-term residential rental, so you then depreciate it over 27.5 years. This means you can claim $10,000 in depreciation annually, and essentially that's an expense. While this example is obviously a very simple one, it does highlight just how big of an impact your depreciation expense can make on the potential profitability of your property. Despite this, we regularly see investors not taking the full advantage of this deduction. And why is that? Well, some investors aren't aware that this expense actually exists, and apparently their accountants aren't aware either, which is why it's very important to get a CPA or accountant that is very in touch with the real estate tax code as well. Others think that they don't take the depreciation expense, then they won't have to pay depreciation recapture. This, though, is a complete misconception. The IRS will claim back a portion of the depreciation when you sell the property as depreciation recapture, regardless of whether you took the depreciation expense or not. So by not taking advantage of this deduction while you own the property, you actually lose even more money to the IRS when you go to sell the property in future. So commonly missed deduction number 2 is mortgage interest. Unless you're paying cash for a property, which is quite unlikely, you've likely borrowed money in the form of a mortgage loan, and your interest rate may vary anywhere between 3 and 7% or more, depending on interest rates, and that leads to a pretty large expense every month. The good news is that real estate investors in the United States particularly, you can actually deduct the interest of that loan against your passive rental income. So let's take a look at another example using the same hypothetical property as before. You purchase the property at $350,000, you put 20% down, and take a mortgage from the bank for the remaining. The bank requires a 6% annual interest rate over your loan of 30 years, meaning your repayment comes down to, let's say, approximately $1,700 every month, which includes the interest payments of around $900. $900 is an expense. And you can deduct it at the end of year to reduce your tax liability. And as you can see, between this and your depreciation, you're likely already able to write off the majority of your taxable income. So very important, those two expenses. The third frequently missed deduction is travel expenses. So there are 2 kinds of travel you might do as a real estate investor. Short distance travel, which might involve driving to your rental property for inspections, showings, or to talk with your tenant or in person. Or perhaps you live in a large city like San Francisco and New York, where property is expensive, and in order to achieve your target return on investment, you have invested out of state. And you need to travel to make important investment decisions, manage tenants, meet with business partners, etc. Either way, the expense accrued when traveling for legitimate business purposes can be deducted as an expense. For short distance travel, the easiest method is to simply claim your mileage at the standard mileage rate. This does change every year. Be sure to check the IRS website for the latest rate. But for long distance travel, you can claim flight costs, accommodation, and even 50% of the meals that you eat on your business trip. It's important to note, though, that you will need to keep a detailed log of your travel, including purpose for travel, to explain exactly what you were doing, as these particular expenses are often reviewed very closely by the IRS. Number 4 is the home office. If you run your rental business from home and you have an office space that you work from, you should be able to claim that space and the office costs associated with it as a business expense. This means your printer, computer, stationery. It can mean, a portion of your home can also be deducted. There are a few rules around this. For example, the rooms have to be used specifically for your business purposes. Can't be a cross between, you have a laptop and you sometimes use it. It needs to be separated from the rest of the house, and it needs to be dedicated as a office space. And often that means a separate room with a separate door. You can't, for example, convert a corner of your living room into an office space. You'll want to discuss the details with your accountant to make sure that you're actually doing this correctly. Number 5, this is a very commonly missed deduction, insurance. Every property you own should have insurance, and any insurance premium you're carrying, whether it's a liability, theft, fire, flood insurance, or another kind, can all be written off because it is an expense. Number 6, HOA fees. Homeowner association fees are regular payments made to homeowner associations. So generally, these fees go towards a variety of things, including maintenance, amenities, services provided within the community or complex. And because these fees are a necessary or compulsory cost of operating your rental property, if there is an HOA or if it's a part of an HOA, you can typically deduct them as a legitimate rental business expense. There are some restrictions to this, though. You might not be able to deduct an HOA fee that covers a special assessment for improvements. In this scenario, you may be able to recoup your share of the cost of the improvement by taking a depreciation. Additionally, if you use the rental property for personal use for a portion of the year, then you can only deduct a portion of the HOA fees from your tax return. The 7th commonly forgotten tax write-off is your employees. So whether you employ contractors or have staff, you can claim their wages against your income as a business expense. The US government wants you to employ people as it drives spending back into the economy, and so any wage costs that you pay out can be offsetted as long as it's tracked and reported at the end of the tax year. And the final expense on this list is maintenance and repairs. This includes any work you do to a property to maintain its current condition. This work must be necessary and ordinary. It's important to differentiate repairs and maintenance from capital improvements. Expenses that are deemed capital improvements cannot be deducted. Instead, those particular improvements need to be depreciated. And generally speaking, anything that returns the property to its original condition is a repair, whereas anything that adds value to the property is considered an improvement. For example, fixing a leak in the roof might be a repair that can be cost deducted in that tax year, but replacing an entire roof would be typically an improvement to the house and would need to be capitalized and depreciated over a certain period of time. However, even the IRS concedes that it can be difficult to know the differences on some occasions, so best to talk to a CPA when you're trying to decipher this. If you've watched this video and gotten to this point and thought, well, I'm never going to need to pay taxes again, it's important to note that passive losses can only be deducted from passive income. And rental income in most scenarios by default is passive, despite how much work you actually have to put in. In a practical sense, this means that you can only deduct your real estate losses against your rental income. You cannot deduct it against W-2 income or other potential income sources. Now, all of these deductions add up to make one of the many reasons why real estate is such a great investment asset. To make sure you aren't letting any potential deductions slip through the cracks, you need to make sure that you have a system in place to accurately track and report on your income and expenses throughout the year and at tax time. If you have 1 or 2 units, you can typically do your rental accounting using a spreadsheet, but there's a lot of issues that come with the spreadsheet, including not really understanding your financial position or nuances of the portfolio. And basically the easiest and most efficient way to do your rental income accounting is to use a purpose-built property management and accounting software like Landlord Studio. With Landlord Studio, you can digitize receipts, you can track mileage, keep the travel logs, reconcile transactions, and run a range of accountant-approved reports, including Schedule E, which is typically the most important form at the end of the tax year. And all of these features are designed to help you keep accurate records so you can make informed investment decisions and minimize your tax liability. The Landlord Studio scales with you and offers a free plan, so you can actually get started for free. And it's perfect for investors with smaller portfolios. So we encourage you to check out landlordstudio.com and start your free trial. And if you've found this information valuable, hit that like button below, subscribe to our channel, and for more insights, be sure to check out our other videos as well and share this video with your fellow landlords. And of course, if you have any questions or comments, please drop them below. Until next time, have a great day.